everybody, Luke Gromen, FFTT. Hope you are well and having a great week. Definitely having a great week here in lovely Cleveland. Did have a bit of a setback last night with the Cavs, unfortunately, against the Celtics. I thought they acquitted themselves well without Donovan Mitchell, played with a lot of heart. So got to tip my cap to them, but we're heading back to Boston down 3-1. So hopefully we can pull it out, but it's starting to look a little bit grim for my Cavs. So at any rate, let me jump right in. As always, thank you very much for the questions. Really appreciate it. Let's jump right into them. First question is from Wade. U.S. sanctions policy impact on the legal basis for the dollar as world reserve currency. Where will money flee to? I think it's important to highlight. I think nothing's going to happen to the dollar's reserve status. I think we are seeing and have been seeing for a decade the primary reserve status of U.S. Treasuries being eroded by economic reality, realpolitik, and obviously since 2022, U.S. sanctions policy vis-a-vis Russia. Central banks have been moving to gold on the margin over the last decade, accelerating it since 2022, since the Russian sanctions. I think you'll continue to see that. I also think we're seeing at the sovereign wealth fund foreign official level movement into hard assets, productive assets, domestic infrastructure, military spending. When you see those things, consider that those funds, that capital, could have gone into treasuries at the sovereign level, basically sterilizing U.S. deficits, financing U.S. deficits. Instead, basically getting dollar surpluses, returning them to sender in exchange for real world finite goods. So there's really, I don't see any. I agree with the view there's no alternative in the financialized fiat world. There is an alternative that is being used out of the financialized fiat world, with the primary reserve asset being treasuries, into gold, harder assets, infrastructure, into the real world, out of the financialized paper fiat world. From TM, any thoughts on the Meredith Whitney thesis of upcoming silver tsunami, which is, in short, boomers own a lot of houses and they have to sell at some point? It's related to housing, but really could apply to all assets, really. I do agree that you could see housing fire sold in certain markets. To the extent boomers, on average, I think actually well above average, I think the majority of boomers own their houses free and clear. When they pass on, when they go into home health care, whatever the case may be, those houses, I think the ones that are paid off free and clear, I think those are basically lottery tickets to the kids. Sell the house, mark it down, move it. And so from that standpoint, it depends on market, it depends on pacing. But yeah, I think you could see pressure on housing in certain markets at certain times. In terms of other assets, and in particular U.S. Treasury bonds and stocks and other private assets, I don't think those will be allowed to fall sustainably. There will be sales, sure. And when they happen, as soon as it makes Treasury markets illiquid, as soon as it knocks down stocks too far, we've seen Treasury, Fed react with more dollar liquidity. It's intellectually offensive. It is what it is. I didn't create the system. They let the system evolve in a way that the U.S. cannot afford positive real rates for long on treasuries, and they cannot afford a sustained decline in stocks. So neither one will be allowed to happen. Dollar liquidity will be the release valve. So for me, the silver tsunami, as it relates to stocks and bonds, will manifest in periodic waves of dollar liquidity tsunami and possibly even a Fed balance sheet tsunami. In other words, the Fed balance sheet goes higher over time. From AB, do you see any case for equities, or do you see a case for equities continuing to climb up as you've described in your newsletter, and an '08 job market real estate recession in coming months? Or do you think the job real estate crash is already here? I think it's any weakness we see in jobs and real estate is going to increase stress on receipts here in the U.S. And I'm always focused on the U.S. because the U.S. is the center of the system. And so if you increase stress on U.S. receipts, you're going to increase stress on treasury markets, and then we sort of go wash, rinse, repeat. Sustained stress in treasury markets isn't going to be allowed to happen. They will inject dollar liquidity. And so unless the U.S. government suddenly, after 5 years plus of doing this, decides they're willing to stand aside and let themselves be defunded by private markets, triggering basically a debt spiral and a new Great Depression while they stand aside and watch, which, by the way, I think has zero chance of happening. In my opinion, you're not going to get a weakness nominally, or a recession or a crash in the economy nominally. I think it's going to be very hard to have a nominal recession. Real basis, sure. Could GDP fall in gold terms? Could the stock market fall in gold terms and Bitcoin terms? Sure. But that helps the sustainability of the debt. That's a negative real rate. That's your money goes less far. It buys you less stuff. You're getting less stuff, so that's a real recession. But nominal GDP is not falling. And when you have nominal recessions, or when you have real recessions, but strong nominal growth, it feels much more like a boom. Asset prices up, etc. Job market's tight, what have you. From LA, what parts of your core thesis are you more sure of and less sure about, and why? I am more sure the U.S. will not abide Treasury market dysfunction for really any sustained period of time. I'm more sure they will not abide stock price declines on a sustained basis for really any period of time. I'm more sure that reshoring and moving away from China is secularly inflationary. I am less sure that the U.S. can reshore in time, and that even if they do, that it's not already too late. That's something that's really kind of come to me over the last 2-3 months based on some of the things I've seen. Something that I'm less sure of, but that there's not really a cause for is that Russia does not have some sort of political turnover calamity that results in U.S. de facto control of Russian resources like we had basically under Yeltsin. Like I said, I don't have a reason for that, but that's something I just don't have great visibility on. So those are a few of the moving parts within the broader view that I think I feel more strongly and less strongly about. From JL, without change to our fiscal policy, how long do you think we have until the U.S. implodes? I think it's really important to break down the word implodes. What does that mean? I've often said what's normal for the spider is chaos for the fly. What we have seen since 2020 for bonds is an implosion. You've seen a significant drop in the price of bonds. You've seen a significant drop on top of that in real terms for those bonds. We've had that implosion. My view is that bonds will continue to deteriorate on a real basis. I don't know on a nominal basis. It kind of depends, right? You take an extreme case. I think it might end up happening, but it's an extreme case as we sit here today. Fed does yield curve control, and they say 10-year Treasury yields are going to be capped at 4. Right now, 10 years at 4.48%. So the yield would go up 48 basis points, or down 48 basis points, excuse me. The bond's price would go up, actually decent amount. But the underlying inflation in the U.S. would be double digits. Asset price, stock prices would be soaring, gold soaring, Bitcoin soaring, houses soaring, economy soaring. So you'd be losing, the bonds would be re-imploding on a real basis, but you'd actually be making money nominally. Your statement would come in to be green. So on a real basis, it really comes down to is thinking real basis, nominal basis when we think about the word implosion, and knowing that it is a matter of U.S. national security. And that the U.S. government funding goals, funding needs, forget goals, funding requirements require that bonds continue to lose money on a real basis, sustainably, if you don't have a productivity miracle. To me, that's the more likely pressure we're going to see, is continued pressure at various paces on the real value of bonds, in particular, long-term government bonds. So hope that helps in terms of just kind of the thought process about what we're watching. In the fiscal situation that we're seeing, the more the more acute it gets, the more the dollar goes up, the more acute it gets. The more rates go up, the more acute it gets. The more inflation goes up, the less acute it gets. But that puts pressure on the bond markets and pressure on the Fed to help sustain or short circuit any dysfunction, Treasury to short circuit any dysfunction. So the fiscal situation being what it is, the operating room is getting smaller and smaller and smaller. And ultimately our destination, which we should not be surprised when we arrive at, is some version of yield curve control, probably unlikely to be explicit yield curve control, but de facto yield curve control, which is it will be an implosion for the real value of bonds, but what it's going to feel like is a really good economy. You're going to see nominal GDP running 8, 10% in America. You're going to see CPI running 8, 9%. You're going to see stocks. You probably see a bit of a sector rotation, but again, if real rates are negative, maybe not that much of a sector rotation. You'll be seeing a fleeing out of the $130 trillion in bonds, looking for a home in $65 trillion of dollar equities, looking for a home in $14 trillion of gold, $1.2 trillion in Bitcoin. You get the point. So for me, I think the pressure has been it's already started on a real basis, and I think it's going to continue. From NF, how would you approach the construction of a Rust Belt emerging market ETF? Appreciate the question. I said something on X yesterday that my favorite emerging market remains the U.S. Rust Belt. I would probably just do a conglomerate of electrical infrastructure, industrials, energy production across a number of different sources, so gas, oil, industrials, like I said, semiconductors, very big Intel plant going up down in Columbus eventually. They've got labor tightness. Water, and then I think grains too. Both, obviously, we grow a lot of grains here in flyover country, Rust Belt flyover country, and there's a tie-in with energy. There's a very big liquid fuels infrastructure based off of ethanol that ties back to grains. So from GH, Luke, I heard a narrative recently that fiscal dominance is diminishing in 2024 because the fiscal spending that was geared toward injecting cash into households has declined significantly recently. Do you think this idea has merit? I think it depends on the level of the dollar. The higher the dollar, the more we're going to be in fiscal dominance and vice versa. Holding the dollar steady as a consideration, no, I don't think the idea has merit. So in COVID, interest rates were zero, so interest expense was really low, and we had $1 trillion in stimmy, more direct to households. $1 trillion deficit plus the low level of interest. Now we have high interest, $1.2 trillion, no real stimmy, but deficits are deficits. It's the same dollar deficits. They're not that much different in terms of dollar amounts. The difference is that the stimmy to a household is like a heroin injection into the jugular, whereas the interest expense deficit, defense spending deficit, tends to bleed into the economy on a little bit more gradual basis, more like sort of a drip IV, but you're comfortably numb either way. So to me, it's really just a question of how fast those deficits get into the economy. And I think it's partly the reason why all of a sudden we're starting to see inflation secularly rise again, is the drip's starting to take effect. From SC, hi Luke, I'm a subscriber, big fan of FFTT, thank you, and thank you for your business. My question is, what is going on with the Japanese yen, and could this be a catalyst for a major credit event? Left to its own devices, yes, in my opinion. We've been highlighting for clients for a number of years. We've put it on X a couple of times recently. 10-year treasury yield for the United States against the dollar yen. And the weaker the yen gets, the higher 10-year treasury yields go. And so we've seen some people saying, yen's going to go to 180 against the dollar. Maybe. And if the correlation holds, that implies a 6.5 or 7% 10-year treasury yield. That's going to be a credit event like no other. Seen some people say the yen could go to 200 ultimately. Again, maybe. But if it does, and that relationship holds, and I think it will, given the United States net international investment position being as high as it is. In other words, foreigners have a lot of dollar assets to sell to defend their currencies. If the relationship holds, 200 yen is like 9-10% of the 10-year treasury. That would be the mother of all credit events, which is precisely why I think we've seen in recent weeks the Bank of Japan come in and intervene. Why we've seen Yellen start talking about currency moves getting too extreme, then okay, we can do something about it. Ultimately, 9-10% treasury yields, forget 9-10, 6.5, 7, puts the U.S. into a debt spiral, puts the world into a debt spiral, and what that credit event, left to its own devices, no intervention, just the math, is dollar up, yields up, stocks down, receipts down, economy down, issuance up, treasury issuance up, yields up, dollar up, wash, rinse, repeat until basically most assets go no bid and the dollar goes to some really big number. And when I say no bid, S&P, tiny number. That's how that would go. Left to its own devices, no interference. But that gives you a sense of the stakes of how the policymakers are going to intervene, in my view, to prevent that. And ultimately, the way you prevent that is a steadily weaker dollar. So we've seen some dollar weakness since the Bank of Japan interventions a couple weeks ago. We'll see if it continues. You know, that they went right when the yen was threatening to get disorderly in terms of the weakness. That's where that came in. I think you will continue to see key levels on currencies defended aggressively against the dollar with the Fed and Treasury's blessing because of the stakes I just laid out. Final question from KL. My question is, what are your 3 top unknowns for precious metals and hard recession going forward? For me, again, hard recession is on a real basis. It's not nominal. I don't think we're going to get an 08, an 01, a 91, because to get that with debt deficits and net international investment position where it is requires the U.S. government to stand aside and let a debt spiral kick off that defunds every Western sovereign, including ultimately itself. It makes no sense, and I don't think it's going to be allowed to happen politically. On a real basis, look, we get some sort of effective yield curve control at 4 and inflation at 8. There's a recession. Your money is declining a lot in value. Then the amount your money buys is shrinking. That's a recession on a real basis. But I don't think it's going to happen in nominal terms. It could happen in gold terms. Could happen in Bitcoin terms. I think it's been happening. In terms of productivities, in terms of known unknowns for the precious metals, productivity miracle. We get some sort of nuclear fusion or AI that's very energy efficient. And basically, if that happens, you really don't need gold or Bitcoin. You don't need the neutral reserve asset that preserves your purchasing power in energy terms. Energy is basically free. If energy is free for everybody, the debt's all going to be made whole on a real basis. You want to own equities, you want to own other assets. But I don't think that's very likely to happen, but that's sort of spitballing about what that could possibly look like. So with that, I'm going to wrap it up for today. Thank you, as always, for joining me. If you like these updates, check out Tree Rings, FFTT-LLC.com. 10 most interesting things. Brief synopsis about what grabbed us about each of those things, how it changed our mind or reinforced a way we'd already been thinking about the world more strongly. A lot of great feedback on it, so check it out if you're interested. Otherwise, everybody have a great rest of the week. Look forward to chatting with y'all soon. Take care, everyone.